The process of closing the books basically allows us to end the accounting period for 1 year and make us ready to begin the new accounting period with new records. The records that we need to keep separate year to year go on the income statement and the retained earnings statement, because that's the reason we're separating things into periods in the first place. The periodicity assumption requires us to break things into periods so we can measure them. So the only two statements that measure a period of time are the income statement, which have revenue and expense accounts. And right after the income statement, we do the retained earnings statement, which shows us what happened to the net income and the effects of dividends. So in essence, all revenue accounts, all expense accounts, and the dividends account need to close at the end of every period. So they are called temporary accounts. They're only called temporary accounts because we close them at the end of a period. Again, the most common period in which we close the records on an accounting, in accounting, is a 1 year period of time. And whether the company uses the calendar year or a fiscal year, it's still 1 year. What happens is after that year is done, we have to close the record on that year and start the very next day, which indicates a new accounting year, with balances in the revenue accounts for zero. All the expense account balances would be zero, and the dividends account would also be zero. So we can start counting revenue and expenses and dividends for the new period, keeping them separate from the old period. The idea of closing the books is bringing these accounts, the revenue accounts, the expense accounts, and the dividends account, to zero at the end of the accounting year. That's it. That's basically what we're going to be doing. Notice there are a number of accounts that do not close. We call those permanent accounts. Permanent accounts are basically on the balance sheet, right? All of your asset accounts never close. Why? Well, they're not subject to that accounting period. Remember, the periodicity assumption means we have to break up the accounting. We have to have the accounting life of the business broken into time periods. We use 1 month, 1 quarter, and 1 year. But that only affects the income statement, which is revenue and expenses, and the retained earnings statement, which is the net income minus dividends. It doesn't affect the balance sheet. So all balance sheet accounts are permanent because it does not go through the process of closing at the end of an accounting period. So assets are permanent accounts, they never close. Liability accounts are permanent accounts, they never close. And stockholders' equity accounts are permanent accounts, they never close. They don't have to go through this process of closing. But look what happens here, right? Our revenue and expenses give us our net income. Our net income minus dividends give us our retained earnings. So eventually, everything that we do here will get transferred into a permanent account, retained earnings. And so that allows us to close the record on one accounting year because we've transferred all those balances over to a permanent account. So we can start the new year at zero for all revenue accounts, all expense accounts, and our dividends account. And that's the process you're going to see today. It's a 4-step process. So let's take one step at a time, please. And when we say closing an account, all we want to do is bring the account balance to zero. Okay. In order to bring an account balance to zero, it's quite easy. The debit side and the credit side have to equal. So if you have $100 on the credit side and $100 on the debit side, you have a zero balance. There's no balance because the credit or debit side is not greater than each other. So there's no balance, it's zero. So that's all we're doing with these closing entries that we're going to be learning about, is we're simply bringing those balances in the temporary accounts to zero. okay? But there's a way to do it that you're learning. The first thing we do is we have to zero out, close our revenue account. You know that revenue has its account balance sitting on the credit side. Revenue would have a normal credit balance. Okay. Well, to get revenue, the revenue account to zero, we're going to have to put an equal amount on the debit side. But once we do that, we need an offsetting credit. Where does that go? That goes into a temporary account called income summary. Income summary is a temporary holding account that we use during the closing process. Very, very simple. It's a very simple account that we use only at this time. Otherwise, it doesn't really have a purpose. Okay. So we close our revenue account and we throw all that money into the income summary account. And after that, our revenue accounts are zero. The second thing we do is close all of our expense accounts. Each individual expense account has to have a zero balance. As you know, expense accounts have their balances on the debit side, right? So to get any expense account to be zero, you have to put an equal amount on the credit side. Okay. So you're going to be crediting each and every expense account in order to get it to zero. And you're moving all those debits temporarily to the income summary account. At the end of that, all of your expense account balances will be zero. Okay. What's left now is the third step. This income summary account, which was a temporary account in which we needed to throw in all of the revenue and throw in all those expenses so we can close those accounts, is no longer needed. But what's sitting in income summary? All the revenue is sitting on one side. All the expenses are sitting on the other side. Your income summary is looking very much like an income statement, with total revenue sitting on one side, the credit side, total expenses sitting on the debit side. Okay. So that means that the balance in income summary is going to be equal to the profit of the company or the net income. So the third thing we do is we move that balance to retained earnings, which makes perfect sense because we would add it to the retained earnings statement, right? What's left here in income summary is basically the net income. So we close net income by moving its balance over to retained earnings, and we're basically done with the income summary account. The last step that we do is we close the dividends account directly into retained earnings. Now, the dividends account has a normal balance on its debit side. So to close the dividends account, we have to put an equal credit in there and move the debit over to retained earnings, which is what we do anyway on the retained earnings statement. We subtract out the dividends. So this is going to look very much like what we do on the income statement and the retained earnings statement, if you can follow. Those are the 4 steps. This is what it actually looks like in the journal. Anytime you see the word entry, you know it's going in the journal because the journal is the entry point for all accounting to happen. And here's the very first entry that we did. We had to close service revenue to income summary. Service revenue, to close an account, you simply want a zero balance. So this is the account for Sierra Corporation. It had a $10,600 balance on the credit side. So we debited equally, right? The $10,600 debit equals the credit side. So now that account is zero. And we move it temporarily to the income statement account. We do the same thing. The second thing we do is we close each individual expense account. Look, each individual expense account is going to get an equal credit, so the debit and credit side are equal. That makes all those accounts zero balances. The total is going to go in income summary. Now look what's sitting in income summary. The $10,600 is the total revenue. The $7,740 is the total expenses. I hope this looks familiar because that's exactly what was on the income statement for Sierra Corporation. The third step is, now that you know that in income summary you have all the revenue and all the expenses, the balance is going to be the net income. So that net income needs to be transferred to retained earnings. So in order to transfer it to retained earnings, we close the income summary account with a debit. Now there are equal amounts on the debit and credit side for income summary. And we move the net income, this is the net income, over to the retained earnings account. Remember, a credit to retained earnings increases retained earnings. That's what net income does. And the very last step is closing the dividends account to retained earnings. So this debit to retained earnings lowers retained earnings, which is what dividends does. And this credit to the dividends account brings the balance to zero. So this is what it would look like in the journal. The next slide is a graphic approach, step by step, of what we're doing. So follow me here with step number one. Step number one was we wanted to close the revenue account. Remember, revenue had a $10,600 credit balance in the account. To close the account, you have to have both your debit and credit side equal. That's why there was a debit of $10,600 to service revenue, because now the balance in service revenue is zero. Both sides are equal, zero balance. And we moved the revenue. This is where all the revenue went, right? We moved the revenue over into income summary account, which is that temporary holding tank that we use here. That's the first step. Look at the second step. All the expenses had to be closed. So again, salaries and wages expense had a debit balance of $5,200. All expenses have their balances on the debit side, right? So to close an expense account, you have to have an equal credit. So this account, salaries and wages expense, for example, now has a zero balance. Why? Because the debit side is equal to the credit side, so there's no balance in the account, it's a zero balance. So all of these accounts are now zero. What happened to all that money? Well, the total expenses, okay, these are the total expenses, $7,740, is sitting on the debit side of income summary. Income summary account looks like your income statement. You have all the revenue on one side, all the expenses on the other side. What's going to be the difference here? Well, the difference is net income. Okay. Net income belongs in the retained earnings account. So the third thing we do is transfer the net income out of income summary into the retained earnings account. Notice income summary now has $10,600 on both sides, which means that account is closed. It has a zero balance, and we're done with it. We don't need it now until the next time we do closing entries next year. But look at the retained earnings, right? We added the net income. This $2,860 on the credit side is the same as adding net income. The fourth thing we did was we closed the dividends account. Dividends has a normal balance on the debit side, so we had to make it the credit side equal to get the balance to zero. Well, it's a $500 credit to dividends. The $500 debit moves to retained earnings, which makes perfect sense because on the retained earnings statement, we take away, right? We subtract out the dividends, and the debit to retained earnings shrinks retained earnings. Retained earnings is a stockholders' equity account. It increases on the credit side, it decreases on the debit side. Now look at the balance in retained earnings. The balance in retained earnings, $2,360, is exactly what you see on the retained earnings statement. Zero beginning balance, adding the net income, subtracting out the dividends, gives you the new balance in retained earnings at the end of the month. So all these are gonna equal. The income summary account is gonna look like your income statement, and your retained earnings account is gonna look like the retained earnings statement. Okay. After we're done with all the closing, there's actually one more trial balance that we run called a post-closing trial balance. And a post-closing trial balance will simply show that all of these temporary accounts, right, the revenue accounts, the expense accounts, and the dividends account will simply have a zero balance. Okay. And all of its summary of that will be already transferred into retained earnings, which is a permanent account. So it'll be there. We're not missing anything. Look what we've done. Steps 1, 2, 3, and 4. This was all chapter 3. This is all chapter 3. Step 5, 6, 7, 8, and 9. This is all chapter 4. This is the entire accounting cycle that you just did in 3 and 4. I think it might, if anything, give you a better understanding and appreciation of how much knowledge it takes even just to be a bookkeeper today. Never mind going in and studying accounting even more, in more detail. But we did quite a bit. We did quite a bit. And there's just a summary that I'm not going to go over, but it just basically goes over those 9 steps. So learning objective 4 ends with the closing entries. And this is going to be part of your homework clearly, as well as a summary problem of everything in chapter 4. And we'll talk about the fact that we're going to be meeting again before the test is due, but I'll talk to you about that right after we review this. Hancock Company has these balances on its adjusted trial balance. And it asks us to prepare the entries to close revenue account. So the first thing we want to do is follow the steps. Close the revenue account. Where's the revenue account? Service revenue, $98,000. Well, you know this balance is on the credit side of the service revenue account. How do we close it? Well, we're going to debit service revenue. That brings the balance to 0. Move that over to income summary. The second thing we do is close the expense accounts. What are your expense accounts? You have rent expense, you have salaries and wages expense, and you have supplies expense. Those 3 accounts are expense accounts, right? You know, just because there's a whole bunch of accounts here listed doesn't mean you need them all. Like, for example, this accounts payable account is a liability account. It doesn't go through the closing process. It's a permanent account, so we can ignore it. The same thing here. Accounts receivable is an asset account. Asset accounts don't go through a closing process. That's a permanent account. The only thing that goes through the closing process are the temporary accounts: revenue, expenses, and dividends to come soon. Okay. So the second thing is we close all these expenses. So we have a lot of expenses, and all these balances in the account are sitting on the debit side. So to close each expense, it requires a credit to each account. The total amount of expenses are going to go into income summary. So each individual expense account gets a credit. The total goes in income summary. Look at what's going on in income summary. Income summary, you should be able to read this. This 98,000 is all of its revenue. This 80,000, it's all of its expenses. You should be able to read this like you do an income statement by now. So the difference between its revenue and expenses is going to be its profit. This company had an $18,000 profit. Just by looking at income summary, which I told you reflects the income statement, it's pretty good. So now we don't need income summary because now our revenue and expenses are done. So let's move that profit out of income summary into retained earnings where it belongs. So we close income summary with the debit. Remember that 18,000 is the difference between your total expenses and your revenue. And we move that to income summary on the credit side. Income summary stockholders equity account, it increases on the credit side. The last thing we have to do, the 4th step, is dividends. And they paid 15,000 in dividends. This is sitting on the debit side of the dividends account. We have to close that and move it to retained earnings. So we move the debit to retained earnings, close the dividends account with a credit. And those 4 steps is what it takes to do the closing process. Okay. Only affects the temporary accounts that we just went over, and all those 4 steps repeat. So you get used to it. Questions?